And let me now move on and explain the sort of international money flows that are recorded within these four subsections of the financial account, the second main component of a country's balance of payments. So within the financial account, you first of all have the foreign investments part, and as the name suggests, here you record the flows of international currency because of the foreign investments received and made by the country throughout the period of the year for which you are making that balance of payments. Now, from the context of Pakistan, foreign investment received simply means that a foreigner decides to invest in Pakistan, and to do that, obviously, he will have to bring money into the country. So the total amount of foreign investments received in the entire year are recorded as a positive value, reflecting they are creating an inflow, whereas sometimes a Pakistani may decide to invest in some other country. So for instance, a Pakistani may decide to invest in New York Stock Exchange. That is where we say foreign investments are being made or taken out as far as Pakistan is concerned, and therefore Pakistan would record it as an outflow or a minus amount in the foreign investment part of the financial account of its balance of payment. So nothing really complicated over here. So let me just move on to the next part, the international loans. And to understand the sort of international money flow that you record in this section, you just need to realize that countries, they do lend and borrow to each other. They give and take loans from each other. And countries like Pakistan usually are borrowers, and we receive or take loans from other countries. And the important thing here is to remember and understand that these international loans received in, let's say, 2020 will affect the balance of payments of 2020, and they will affect the balance of payment of 2021, 22, 23, and the future years as well. And you need to understand what will be the impact on the year's balance of payment in which the loan is taken, and what will be the impact on the balance of payments of the future years. And it is really easy, simple to understand. You see, if Pakistan is taking or receiving a loan in 2020, then in 2020 money will flow in. So here in the international loans part of the financial account, you will record the total amount of loan received as a positive value, reflecting it creates an inflow of international currency into Pakistan. But then in the next years, 21, 22, and so on and so forth, you will have to pay interest on these loans that you have taken. Interest, remember, is a form of income, and we have just learned that when income moves out of the country, it is recorded as this interest paid out within the incomes section of the current account. It is recorded as an outflow. Money is moving out because you have to pay interest to the countries from which you are taking loan today. So that is an important thing for you to understand. This is something that will be tested in your A-level MCQs, that if you take a loan today, there will be an inflow in the financial account this year. In the future years, because of this loan, there will be an outflow from the incomes section of those future years' current accounts. And with that, let me just come back to completing all of this that we are going after over here. So international loans, remember, received creates an inflow, but you also give loans as a country. And if you give a loan to some other country in 2020, then in that year, that would mean an outflow recorded here in loans given out. But then in the future years, you will receive interest payments. There will be inflows in the incomes section of the current accounts of the future years. So that is how transactions sometimes affect both the financial and the current account as well. So with that detail and important detail, let us now move on to this next part of the financial account, which is very, very interesting: saving deposits. Now simply this means bank accounts. And if foreigners, they decide to bring cash into Pakistan, open a bank account and put their money in Pakistan's bank accounts, then we say that saving deposits are being received, they are creating inflow, so we record that amount as a plus. Whereas if Pakistanis decide to take their cash out of Pakistan, open a bank account in some other country and put their money in foreign countries' bank accounts, This is where we say that saving deposits are being taken out of the country, and therefore money is moving out, outflow is being created. Now, the thing that you have to understand here is that we are not talking here about an average individual moving money around from one country to another country. What we are talking here about are huge financial institutions such as hedge funds, and you can think of insurance firms. And these firms usually have a lot of cash on their balance sheets, and they want to earn interest rate on the cash that they have. They want to put it in the bank account and earn cash. And what they do is that regardless of in which country they are based, they look around globally and try to see which country is offering what interest rate. So for instance, if they look at Dubai and they see the interest rate is 2%, if they look at Pakistan and they see interest rate is 6%, then chasing this higher interest rate, they will suddenly take their cash into Pakistan, open a bank account, and therefore Pakistan will receive saving deposits. There will be inflows of international currency. But then the interesting thing is that, look, these interest rates in turn, they are very volatile in every country, because there are, remember, they are interest rates, they are tools of monetary policy. So it is normal for the governments of, or I should say the central banks of countries, to keep on changing these interest rates. So while higher interest rate today attracts inflows of these saving deposits into Pakistan, but as soon as Pakistan's interest rates change and other countries' interest rates change, and you end up in a situation where interest rate in Pakistan becomes relatively lower, then these hedge funds and insurance firms will suddenly take money out of Pakistan and they will move it into the country which has now a relatively higher interest rate. So saving deposits will be taken out and they will create outflows for your country's balance of payment. And these saving deposits, or I should say the money flows because of these movements in saving deposits, they are also sometimes known as, very interestingly, hot money flows. Hot money in the sense that they come in very quickly, but then equally quickly these money flows move out as soon as the interest rate becomes relatively lower. So hot money flows, and they can create a lot of problems. Because remember, this cash is only chasing the highest amount of interest rate. There is no other consideration. And therefore, these movements of hot money into and out of the country are very volatile. And therefore, they create problems sometimes in terms of the balance of payment. Suddenly, there is a huge inflow and then there is a huge outflow. And of course, you will understand those implications as we go on. But for now, remember, and that is very important for your A-level exam, that the inflows and outflows because of these saving deposits, the main determinant is the interest rate, or I should say the relative interest rate of the country. Now with that, let me now move on to the last part of the financial account, which is known as the FX reserves of the central bank, or simply sometimes the FX reserve sections. Now it is very important for you to understand the sort of inflows and outflows that are recorded within this last part of the financial account. But before we can understand the details of this FX reserve section, you need to remind yourselves of a couple of basics that I explained about these balance of payments. And the things that I want you to remember before we go into the details of FX reserves, first of all, I want you to remember that all of these international transactions that then create outflows and inflows which are recorded in the balance of payments, remember that all of these international transactions, they take place in the international currency, the US dollar. So although we are talking about the balance of payments of Pakistan, all of these inflows and outflows, these pluses and minuses, and these are measured or recorded in dollar value, dollar terms. So that's the first thing. We are recording the flows of international currency within this balance of payment account. And then secondly, remember something that I explained in detail, that whenever there is an inflow of the international currency into Pakistan, that would eventually lead to or cause or create demand for the local currency, rupee in this instance. And whenever there is an outflow of dollars, the international currency from Pakistan, that would in turn imply or create the supply of the local currency, the rupee. Now, I have explained the reasons for that in detail, but here I just want to remind you, these inflows and outflows are being measured in the international currency of dollars, and all the inflows create demand for the local currency, the rupee, and all the outflows of international currency will create the supply of a rupee in Pakistan. Now, with that in mind, let us come back to this FX reserves of the central bank. And what you need to understand, and first of all know, is that the central banks of all the countries, they usually keep some amount of FX reserves, meaning they keep some reserves of the international currency, the US dollars. And for instance, the Central Bank of Pakistan, it usually keeps FX reserves worth around $15 billion. Sometimes it's less than that, sometimes it's more, but around $15 billion. So serious amounts of FX reserves are kept by the central banks. And then what they do is that, assuming they start off the year with $15 billion of FX reserves, these central banks, they play around with these reserves. Sometimes they will decrease the amount of these FX reserves, or we say they will use these dollars and to do something, and therefore they will draw down on their FX reserves. And sometimes these central banks will buy more dollars, so we say they will buy FX reserves, or we say they will build up the amount of dollar reserves they have. So build up or draw down. And the only reason why the central bank will either buy more reserves or use and draw down their FX reserves is simply to artificially create an inflow or outflow of the international currency into Pakistan, and therefore artificially create either demand or supply for the local currency. So if the central bank, for instance, decides that, okay, I'm going to lower, draw down and use these FX reserves, then what they do is they go to the FX market, they use or sell some of these dollars, and in return, they demand the local currency, the rupee. So what you need to remember is that whenever the central banks use or draw down their reserves of the FX, of the foreign currency, the dollar, then they will artificially end up creating demand for the local currency. They will buy rupees in return. And since demand for local currency is created, that should remind you that this action will also create an inflow of dollars, inflow of the international currency. Whereas if the central bank buys and increases and builds up its FX reserves, then what they need to do is that they will go to this FX market and they will start buying dollars to build up their FX reserves. But to buy these dollars, to build up these FX reserves, of course, they will have to supply the local currency rupee, and therefore you can remember that whenever the central bank is building up reserves, it is creating supply of the local currency, which is equivalent to saying there will be an outflow of the international currency. Now you will understand the importance and significance of these inflows, outflows created by the central bank, which are recorded in this FX reserves, as we go along and discuss and develop other details in the remainder of the section. But for now, that completes all the details that you need to know about the financial account, all of its subsections and the sort of flows that are recorded within each of these subsections. And then as we did for the current account, we can add all the inflows with all the outflows that take place because of the transactions being recorded only within the financial account. And the net answer you will get is known as the balance of the financial account, or simply the financial account balance. Now, if your financial account balance, the result of summing all these inflows with the outflows, if the net answer is plus, then it means that the financial account is in a surplus and net more money is moving into the country because of the transactions being recorded in the financial account. Whereas a negative financial account would mean that the financial account is in a deficit and net more money is flowing out of the country because of these transactions being recorded in the financial account. And with that, we have now the complete or almost a complete understanding of the basic structure, the basic knowledge of balance of payments that you need to have before we can talk about the analysis of some of the BOP problems that the countries face. And what I want to do here is to leave you with a very neat version of the current account, the financial account, and the subsections that we have been building over the last couple of videos. So this thing over here, and this is what you basically need to now memorize. current account, its subsections, and the sort of transactions that are recorded within these subsections, and similarly the financial account, its subsections, and the sort of transactions that goes on within these subsections of the financial account. And remember and memorize these things, knowing your basics, that all these pluses reflect inflows of international currency and all these Ds reflect the demand for local currencies that these inflows will create. And similarly, all these minuses reflecting outflows of international currency, and they would simultaneously create supply of the local currency. And you should be able to memorize these things so well that you should be in a position where you can just close your eyes and visualize these current financial account and their sections and subsections. Now those are the basics around which we will build the analysis of some of the balance of payment problems going ahead in this section. But before I move on, I just want to mention very briefly that although we have been focusing on just the two main components of the balance of payments account, but there is a third section in addition to current and financial account, which is known as the capital account. But this is not important, it's insignificant, because the sort of inflows that are supposed to be recorded here in this capital account, they hardly ever take place. Because here you record the flows or the adjustments you have to make when a country forgives a loan that it has given to some other country. So debt forgiveness and the sort of flows that would create are recorded in this capital account. But rarely do countries forgive the debts that they have given, and therefore usually for many countries this capital account is empty. But for the sake of completeness, you need to know at least the name, that there is this third section, the capital account, and then there is also this fourth section, which is known as net errors and omissions. And here economists realizing that, look, if you are trying to measure the inflows and outflows of the currency from a country throughout the year, then you're bound to make some mistakes. You are going to miss out on some of the transactions, you are going to underreport some of them, you are going to overreport some of them. So economists usually throw in an estimate of the overall net errors they think will be made throughout the year. They throw that amount and estimate in this net errors and omission section. And it is important to know of these because you need to know the formula that you can use to measure the balance of the entire balance of payments. Now, balance of entire balance of payments, you see, is where you are trying to add up all the inflows that occur within the entire balance of payment with all the outflows that occur in your balance of payments. So to measure that, a quick way is that you just take your current account balance, you add that with your financial account balance, and then you add these capital account and net errors and omissions. So that is the sort of formula that you will sometimes need in your MCQs. But for all other reasons, for all other things that we are going to understand, we are going to focus just on the current and financial account, the parts where actually transactions and inflows and outflows take place. Anyhow, the complete balance of the balance of payment, remember, if the answer you get is minus, it means that net more money is flowing out of your country, and we say that the balance of payments is in a deficit. And if the net answer you get, the balance of the entire BOP, if it is a positive value, that tells you that net more money is flowing into the country, and we say the balance of payment of the country is in a surplus. So those are the basics of the balance of payments that you need to know. But before you proceed with the remainder of the videos in this section, I also want to highlight that just this basic knowledge of what is the BOP and what are its different parts, simply that knowledge is also tested in your A-level exams. And as far as essay questions are concerned, sometimes the examiner will ask you to explain all the different components that together constitute the balance of payments. It's a very easy question. You just have to reproduce this table over here. Just go through each of these sections and the subsections and tell the examiners what are the sort of transactions that will be recorded. So it's a memory-based question. And sometimes the essays, instead of asking you to lay out the entire balance of payments, they will focus on current account, and there you will have to explain the sections and the subsections that together compose the current account. So again, straightforward questions. What is a current account, and what is a deficit of a current account? So explain these components, the transactions, and tell the examiner that the deficit simply means that net outflows in the current account are greater than the net inflows. So that will take care of the essay questions, testing your knowledge of these basic ideas. And then in the MCQs, I have already mentioned at the end of the last video that there are some MCQs, MCQ number 1 to 10 of your MCQ bank on this section, that tests your knowledge of these different sections of current account. But now after this video, I want you to go through MCQs 11 to 23 of the MCQ bank, which I call the MCQs on balance of payment transactions. Now these are the sort of MCQs where the examiner will tell you of some economic thing taking place, some scenario taking place, and he will ask you that as a result of whatever has been mentioned, which part of the financial account will be affected. Now to get through those questions, you basically again need to have a memory of which transactions are recorded in which parts of the balance of payments. So usually the examiner will give you a situation where you will end up with an increase in exports and imports. So you need to remember that, look, then current account straight section will be affected. Sometimes the examiner will tell you that the country has increased interest rate. That you need to remember, when interest rates increase, that will create inflows of saving deposit received. So your financial account will be affected. And sometimes the examiner will, and he loves to give these questions where he will tell you of a transaction that will affect both the current and the financial account. So maybe he will ask you that Pakistan takes a loan in 2020. How will it impact at 2020's balance of payment and the future year's balance of payment? So there, remember, we have looked at this thing in detail, that in the year you receive a loan, you will receive an inflow in the financial account, but then in the future years, your interest payments will move out of the income section of the current accounts of the future years. So that is the sort of things that you will be tested upon based on the testing of the knowledge of these balance of payments. So once you have gone through those questions, it will also help you revise all these basics, and then you can proceed with the rest of the videos where we'll talk about the problems faced by the countries regarding their balance of payments.